Gold and silver are back in the spotlight again, and this time, the story is bigger than just another price move. After the massive bull run we saw in 2025, a lot of people expected 2026 to be the year where metals either completely crash back to earth or exploded even higher without stopping. But what we are getting instead is something much more interesting. A market that is still incredibly strong, but now moving through a violent battle between profit-taking, fear, geopolitics, and fresh demand. And that is exactly why so many investors are watching this moment closely. Because when gold hits multi-thousand-dollar record levels and silver surges to heights very few people thought possible just a year earlier, the next move matters even more than the rally itself. In 2025, gold delivered one of the most historic runs in modern market memory. Silver was even more dramatic, with huge percentage gains that reminded everyone just how explosive this metal can be once momentum kicks in. But in early 2026, reality hit. Prices corrected sharply. Gold pulled back hard from its highs. Silver also lost momentum and started swinging wildly. Suddenly, the market mood shifted from pure excitement to uncertainty. Now here we are in April 2026, and the big question is simple. Was that correction the beginning of the end? Or just a pause before the next move higher? Right now, gold has stabilized back in the mid to high $4,000 range, while silver is trading in that powerful $70 to $80 zone. Those are not weak levels. In fact, if you zoom out, these prices are still extraordinarily elevated compared with where these metals were before the 2025 surge. That is an important point many people miss. When markets correct after a huge run, people often focus only on what was lost from the peak. But experienced investors ask a different question. After all that volatility, where did the asset actually settle? And the answer right now is that both gold and silver are still holding at levels that would have seemed almost unbelievable not long ago. That tells us something important. It tells us the metals market is not just running on hype. There are still real drivers underneath this story. There is still a reason buyers keep stepping in. Over the last week or two, we have seen exactly how sensitive this market remains. Early in the week, both metals came under pressure. Failed US-Iran peace talks, inflation fears, and oil price spikes all created a sudden wave of anxiety across global markets. Gold slipped. Silver fell even harder. And that silver reaction is very important because silver never behaves like a simple safe haven asset. It has a split personality. On one side, it trades like gold when fear rises. On the other, it trades like an industrial metal tied to economic expectations, manufacturing demand, solar growth, electronics, and long-term industrial expansion. That is why silver can look stronger than gold one day and more fragile the next. But then the rebound came. As the US dollar softened and some oil pressure eased, precious metals snapped back. Gold recovered strongly. Silver showed fresh momentum again and started pushing back toward that key resistance area around $78 to $80. That rebound matters because it shows buyers are still active on dips. The market is not simply collapsing. Instead, it is reacting sharply to every new headline and then trying to rebuild. And honestly, that may be the clearest description of 2026 so far. A volatile consolidation year. Not a dead market. Not a runaway straight-line rally. A consolidation year. That means investors are digesting the enormous gains from 2025 while also trying to figure out what comes next. Are central banks still buying aggressively? Will geopolitical stress keep safe haven demand alive? Can silver continue to benefit from industrial demand tied to solar, EVs, and electronics? And maybe the biggest question of all, will the Federal Reserve and the US dollar give metals another major push? Because once you understand those forces, you start to see why this market is still far from finished. Now let's break down what's actually driving gold and silver right now, because this is where the real story is unfolding. At the center of everything is geopolitics, specifically the ongoing tension between the US and Iran. Over the past few days, we saw how quickly sentiment can flip. When peace talks failed and concerns about naval blockades and disruptions in the Strait of Hormuz started rising, oil prices surged past key levels. And when oil spikes, markets immediately start thinking about inflation. Higher oil means higher costs across the global economy. Transportation, manufacturing, energy, everything gets affected. But here's where things get interesting. Normally, rising inflation fears should be bullish for gold. And in many cases, they are. But in this situation, the initial reaction was actually a sell-off. Why? Because markets didn't just see inflation, they saw uncertainty and risk-off behavior. Investors moved into cash temporarily, the dollar gained some strength early on, and metals pulled back. This is something a lot of new investors misunderstand. Gold doesn't move on a single factor. It reacts to a combination of forces, and sometimes those forces cancel each other out in the short term. Then came the reversal. As the situation slightly de-escalated and hopes of renewed talks returned, oil prices cooled off a bit. At the same time, the US dollar started weakening, down around 0.8% against major currencies like the euro in recent sessions. And that is a major driver. Because gold and silver are priced in dollars, a weaker dollar makes them cheaper for international buyers. Demand increases, and prices move higher. This is exactly what we saw. Gold bounced back quickly, reclaiming strength in the mid to high $4,000 range. Silver, as expected, reacted even more aggressively. After dropping sharply earlier, it surged back and started testing that critical resistance zone again near $78 to $80. And this is where silver becomes extremely interesting for investors. Because silver doesn't just follow gold, it amplifies it. When gold stabilizes or starts moving higher again, silver often accelerates faster. That's why we saw silver outperform on rebound days. And one of the best ways to understand this relationship is through the gold to silver ratio. Right now, that ratio is sitting around 61 to 1. That's relatively tight compared to historical extremes, and it tells us that silver is currently holding strong relative to gold. But there's another layer to this story that many people are overlooking, and that is global demand, especially from China and central banks. In the first quarter of 2026, China saw record inflows into gold ETFs. That means both institutional investors and retail participants are actively buying into gold, even at these elevated levels. On top of that, the People's Bank of China continues to accumulate gold as part of a broader strategy to reduce reliance on the US dollar. This is part of a much bigger global trend, de-dollarization. Central banks around the world are quietly increasing their gold reserves. They are not doing this for short-term trades. They are doing this as a long-term hedge against currency risk, debt expansion, and geopolitical uncertainty. And when central banks become consistent buyers, that creates a strong underlying floor for gold prices. Silver benefits from this indirectly, but it also has its own demand story. Industrial demand for silver continues to grow, especially in sectors like solar energy, electric vehicles, and electronics. As the world pushes toward renewable energy and advanced technology, silver becomes increasingly important. That means even when investment demand fluctuates, there is still a structural demand base supporting the metal. So when you combine all of these factors, geopolitics, oil, the dollar, central bank buying, and industrial demand, you start to see why this market is so volatile right now. There are multiple powerful forces pulling prices in different directions at the same time. And that creates opportunity, but also risk. Because in a market like this, prices don't move in a straight line. They swing, they overreact, they correct, and then they move again. So what does all of this actually mean for investors right now? Because this is where most people get it wrong. They see gold pulling back from the highs, they see silver swinging up and down, and they assume the opportunity is gone. They think the big move already happened in 2025, and now it's too late. But in reality, what we're seeing in 2026 looks very different. This is not the end of a cycle. This looks much more like a consolidation phase inside a much bigger trend. And understanding that difference is critical. After a massive bull run, like the one we saw in 2025, markets almost never go straight up forever. They need time to cool off. Early investors take profits. New investors wait for better entry points. Institutions quietly reposition, and prices start moving sideways with sharp swings in both directions. That's exactly what gold and silver are doing right now. Gold is holding strong in the mid to high $4,000 range. Every time it dips, buyers step in. That tells us there is still strong underlying demand. It's not collapsing, it's stabilizing. And stabilization at high levels is often a sign of strength, not weakness. Now look at silver. Silver is behaving exactly how it usually does in these environments. More volatile, more emotional, and more aggressive on both the downside and the upside. It drops faster when fear hits, but it also rebounds faster when momentum returns. And this is where things get interesting, because if gold remains stable, and if the broader trend stays intact, silver has the potential to outperform significantly in the next phase. This is where the gold to silver ratio becomes a powerful tool. Right now, sitting around 61 to 1, the ratio suggests that silver is not extremely undervalued, but it still has room to move if gold continues higher. Historically, during strong bull phases, this ratio tends to compress even further. That means silver rises faster than gold. So when you see silver pushing toward that $78 to $80 resistance zone, it's not just a random move. It's a signal. a signal that momentum is building again. But here's the key point most people miss. This market is no longer driven by just one factor. In the past, you could say gold moves because of inflation, or because of the dollar, or because of central banks. Today, it's all of those things combined, plus geopolitics, plus debt concerns, plus global shifts in economic power. We are in a different environment now. Global debt levels are at historic highs. Governments are spending aggressively. Central banks are walking a tightrope between controlling inflation and supporting economic growth. And at the same time, geopolitical tensions are rising in multiple regions, not just one. All of this creates a backdrop where gold continues to make sense as a hedge. And when gold makes sense, silver often follows, but with more intensity. Now let's talk about positioning. Smart money is not chasing every spike. Institutions are not buying at the top and selling at the bottom. They are accumulating during weakness. They are watching key levels. And they are preparing for the next major move, not reacting emotionally to short-term headlines. That's why dips in gold toward lower levels, like we saw earlier in March and April, are being bought. That's why silver, even after sharp pullbacks, finds support and pushes higher again. This is not random. This is a market being built for the next phase. But at the same time, we have to be realistic about the risks. If the US dollar suddenly strengthens again, if the Federal Reserve delays rate cuts or even tightens further, or if geopolitical tensions ease significantly, metals could face short-term pressure. Prices could pull back again. Volatility could increase even more. So this is not a straight-line opportunity. It's a strategic environment, an environment where timing matters, where patience matters, and where understanding the bigger picture matters more than reacting to daily price moves. So now, everything comes down to one question. What happens next? After the biggest bull run in years, after a sharp correction, and after weeks of extreme volatility, where do gold and silver go from here? Let's start with gold. Most major institutions are not calling for a collapse. Instead, the general expectation is that gold will continue trading at elevated levels throughout 2026. Many forecasts place gold in the $4,500 to $5,000 plus range on average this year. But that's just the base case. Because in a more aggressive scenario, where geopolitical tensions continue, global debt keeps rising, and the dollar weakens further, some projections go much higher. We're talking about potential long-term targets that stretch well beyond current levels. Not immediately, but over time. And that tells you something important. Gold is no longer just reacting to short-term news. It is becoming part of a bigger global shift. A shift where countries, institutions, and investors are slowly repositioning away from traditional systems and toward hard assets. Now bring silver into the picture. This is where things could get even more explosive, because while gold is seen as stability, silver is seen as opportunity. Analysts are generally projecting silver in the $75 to $85 range on average for 2026. But just like gold, that's a conservative outlook. If industrial demand continues to grow, especially from sectors like solar energy, electric vehicles, and advanced electronics, and if investment demand accelerates alongside gold, silver could easily push toward $100 or beyond in stronger scenarios. And remember, silver doesn't move slowly. When momentum builds, it moves fast. That's why even small changes in market sentiment can create large percentage moves in silver compared to gold. And that's exactly what makes it attractive, but also risky. Now let's talk about the two paths forward. On one side, you have the bullish case. If geopolitical tensions remain high, if central banks continue accumulating gold, if inflation stays sticky, and if the Federal Reserve eventually shifts toward rate cuts, this creates the perfect environment for metals to move higher again. In that scenario, gold breaking above previous highs becomes very possible, and silver could follow with even stronger upside. But on the other side, there is the risk. If tensions ease, if the dollar strengthens significantly, or if economic conditions stabilize faster than expected, metals could face pressure. Prices might not collapse, but they could move sideways for longer, or even dip before the next major move begins. And that's the reality of this market. It's not about certainty, it's about probabilities. Right now, gold and silver are sitting in a position of strength, but surrounded by uncertainty. That combination is what creates volatility, and also opportunity. So the real question is not just where prices go next. The real question is how you position yourself in a market like this. Do you chase momentum or wait for pullbacks? Do you focus on gold for stability Or silver for upside? Or do you balance both? Because one thing is clear, this story is not over. The 2025 rally may have grabbed all the attention, but 2026 is where the real structure of this market is being built. And what happens during this phase could define the next major move, whether it's gradual or explosive. And as always, markets move fast, narratives change quickly, and timing matters more than ever. If you want to stay ahead of these moves and understand what's really driving gold and silver, make sure to subscribe to the Gold and Silver Updates, because this is where we break it down in a way that actually makes sense.